A lot of capital loss questions are really loss disallowance questions. The IRS is fine with you having losses. They just don't want you creating losses by selling to yourself, your spouse, or your own entities, then buying right back in. On the EA exam, these show up as quick fact patterns. Your job is to spot the trap and know what happens next. Disallow, adjust basis, or delay the loss. Start with wash sales. A wash sale happens when you sell a security at a loss and you buy the same or substantially identical security within the 30 days before or 30 days after the sale. That's a 61-day window centered on the sale date. It even counts if your spouse buys the replacement shares. The loss isn't gone forever. It's postponed by adding it to the basis of the replacement security. Here's the basis move the exam loves. If a $2,000 loss is disallowed under wash sale rules, you add that $2,000 to the basis of the replacement shares. That means your future gain is smaller or your future loss is bigger when you finally sell the replacement shares. So the rule is really about timing. Also remember, buying an option or contract to buy can trigger it too, not just a straight purchase. What about substantially identical? The course level takeaway is, different corporations are not identical. So selling shares of one company and buying a different company's shares is not a wash sale. And even within the same corporation, preferred stock is not identical to common stock. On the EA exam, they usually keep it simple. Identical stock, spouse purchase, or an option to buy. Those are your big triggers. Next trap, related party sales. In general, if you sell property at a loss to a related party, the loss is not deductible. Related parties include immediate family, like spouse, siblings, parents, and children. It also includes entities you control, more than 50% ownership, including family attribution. Here's the weird part. If the buyer later sells to an unrelated person at a gain, that gain is recognized only to the extent it exceeds the previously disallowed loss. Be careful with who is not related. The exam may toss in step-relatives or in-laws. For this rule, stepchildren, step-parents, in-laws, cousins, aunts, uncles, nieces, nephews, and ex-spouses are not related parties. So a lost sale to a stepbrother, for example, is generally deductible. That's a classic gotcha because it feels like family, but it's not in the IRS definition. Last, worthless securities. If a stock or certain corporate debt becomes totally worthless during the year, it's treated as sold for zero on the last day of that tax year. That deemed sale date matters for short-term versus long-term. You report it on Form 8949 and you literally label it as worthless. Another exam favorite, you get a longer amendment window up to 7 years to claim a worthless securities loss instead of the usual 3. Two final details. To abandon a security, you must permanently give up all rights and receive no consideration. And not everything you call an investment is a security for this rule. Cryptocurrency doesn't qualify under the current definition. So on the exam, if they say worthless crypto, don't jump to the worthless securities rule. Worthless securities are things like corporate stock, stock rights, and certain registered corporate or government debt. Which of the following items does not decrease an asset's basis? The choices include the cost of defending a title to the property, Section 179 deductions, a casualty loss, and a manufacturer's rebate. Think about which one would actually increase basis instead of reducing it. The correct answer is the cost of defending a title to the property. That's a capital expenditure, so it increases basis because it perfects or protects ownership. A tempting wrong choice is the manufacturer's rebate because it feels like income, but it usually reduces the purchase price, so it decreases basis. Marisol received 500 shares of restricted stock from her employer on March 1, 2023, but she forfeits it unless she completes 5 years of service. The stock was worth $15,000 on March 1st. How much does she include in income in 2023, and what is her basis? Options range from including $15,000 now to reporting nothing until vesting. Think about it. The correct answer is that she reports no income in 2023 and has no basis until the stock becomes substantially vested after she completes the service requirement. The stock has a substantial risk of forfeiture. The tempting answer is income and basis of $15,000 in 2023, but that would generally require an 83B election, and the question doesn't say she made one.